Good evening, everyone. How are you all? This is your CA final faculty, CA Rohit Grover, taking up your CA final advanced auditing and professional ethics. Welcome you all to the rapid revision batch. So as you all know that up to the previous video, we have already completed with our 700 series. So in the 700 series, we have understood how to report. We understood 700, 701, we understood 705, 706, 710 and 720. Now today I'm going to start a very important standard series that is called SA-500 series, right or not? So whenever the word called 500 comes to our mind, the first thing which comes to our mind is nothing but called what? Audit evidence series. What is the word, everyone? Audit evidence. Now, if I have to tell you, in total in CA final, you have 35 standards on auditing, as we all are aware of. And those 35 standards on auditing are broadly classified into 5 series. You know that 200 series is there, basic concept series. Then 300 is there where we'll understand how to determine the materiality, what do you mean by planning and all those things. Then we have 400 series where we have the two standards 402, 450. But the biggest and the most vast series which we have among all our standards on auditing is SA 500 series. Now, why I'm saying keep on stressing on 500 series, because in the 500 series, you will find that key audit evidence alone only has 11 standards on auditing. How many, everyone? 11 standards on auditing are there in the 500 series. Now, out of those 11 standards on auditing, rather to what I will say that ki all the standards are only important, right or not? Each and every standard in the 500 is very important. And remember one thing, it's been seen in the last few paper trends that ki almost 16 to 18 marks out of 40 to 45 marks of standards on auditing, which is coming in your CA final examination, is being constituted from this particular series called what? 500. So in the 500 series, there are in total 11 standards on auditing. Started with 500, which will let us know about the 500, called audit evidence. 501, which talks about special consideration. So 505, which talks about external confirmation. And 510, which is nothing but opening balances. 520, which talks about analytical procedures. 530, which talks about audit sampling. 540 talks about accounting estimates. 550, which talks about related party disclosure. 560, which talks about subsequent events, and in the last we have 570 and 580, which talks about going concern, and 580 talks about WRL, written representation letter. Now, what we are going to understand in this session, I'll make you understand the three standards, the very important standards. One is called 540, which is known as accounting estimates. One is known as 570, which is going concern, and one is 560. Anyways, I'm going to cover all the standards, but in this particular in this particular session, we are going to cover the three standards, right? So let us first start with 540, everyone. What is 540? First of all, try to understand whenever you're doing anything in the 500 series, the very first objective you all should have is to ensure that how to obtain sufficient and appropriate audit evidence. Now, when 540 standard comes to our mind, the main thing which you have to understand in this standard is that 540 standard deals with accounting estimates. It deals with what? Accounting estimates. Now, sir, accounting estimate the management does. What is the role of chartered accountant in that? What is the role of auditor in that? Listen to this. When the management is preparing the financial statement, when they are presenting the financial statement, you will be finding that there are so many areas where the accounting estimates are being used. Namely, the areas called provision for taxation, provision for doubtful debt. Am I correct? And the areas called provision for depreciation. So whatever the provision based areas, all these areas are nothing but called what? Accounting estimates. And accounting estimates are those estimates which are made by the management without any specific or without any precise means of what? Measurement. It's an approximation figure. Which figure, everyone? Approximation figure. It is an estimated figure. So auditor under this standard, what he is doing, he will try his level best to obtain the sufficient and appropriate audit evidence to understand the fact that the accounting estimates made by the management should be reasonable and reliable. What are the two things we have to check? Accounting estimates made by the management should be reasonable as well as what? Reliable. This is the major idea behind 540. But before understanding what is the requirement of SA-540, there are some things which you need to understand. Point number one, there are some certain definitions which you need to understand. So what do you mean by definition? There are some definitions which you really need to understand, because remember one thing, in the CA final examinations, technicality in your answer is the primary thing which ICA looks for. Are you getting the point? Now, the fight in the CA final examinations are never between the right answer and wrong answer. The fight in the CA final examination is between the right answer and the better answer. Are you getting the good answer and the better answer? The student who has, there are two set of student, both of them has written the right answer, but the one is getting better marks, the other one is not getting, is not because the other one's answer is right and your answer is wrong. It is because he has written a better answer than you. Now the question arises, sir, how the better answers will be written? The better answers can be written only if you will try to use the technical language which the ICA is expecting from the CA final student. See, foundation level mein it is fine, intermediate level mein it is fine, but being at final level, ICA literally expects that yes, you should know where to use the technicality. So before entering into the standard, we have to understand some of the technical things. So what are those technical things? First thing is we have to understand what do you mean by term called accounting estimate. So if we'll see, accounting estimate is nothing but it refers to the approximation of the monetary amount due to the absence of precise means of measurement. Now let's say for example provision for doubtful debt. Now provision for doubtful debt means ki in this year we are expecting that ki this much of bad debts may happen. Now, when the company does not know how much actually bad debts are going to happen, then obviously they will put in the approximated figure only now. So, approximation of any particular item without the presence of any precise means of measurement, that is called what? Accounting estimation. The major thing is approximation without the precise means of what? Measurement. Is it clear? The second thing what you have to understand is auditor's range. Now, what do you mean by auditor's range? Remember one thing, estimation in such an area where auditor also has to sometimes reperform, recalculate and recompute the management estimates. So when the auditor is verifying the management estimates made by the management, he has to very much ensure that his estimate calculation and the management estimate calculation should match. And even if it is not matching, even if there is a difference between the auditor's estimation and the management's estimation, there should be a range which he can afford. Let's say, for example, according to me, the provision for doubtful debt should come by doing the trend analysis by using my substantive analytical procedure. According to me, it should be 29 crores. But they have put 29.2 crores. So only difference is 20 lakhs. This kind of rate of deviation is acceptable. But let's say, for example, according to me, it is coming 29 crores and they have made only 9 crores. Now look at the deviation. It is 20 crores. That is not acceptable. It means it is going beyond my range. So auditor's range means a range within which the auditor would like to see whether his estimates and the management estimates are matching, and if not matching, to what extent they are deviating from each other. If the rate of deviation is more than what the auditor is expecting, then it's time that he should take some reasonable steps. This is what do you mean by auditor's range. Now, what is the third thing, everyone? Estimation uncertainty. We all know that estimations includes approximations. Approximations means no certainty. And when there is no certainty, there's definitely a scope of uncertain and there's definitely a scope of some error. Are you getting the point? That is known as estimation uncertainty. Now see, the susceptibility of the accounting estimate due to inherent lack of what? Precision. Because estimate is something which we can't say precisely. I cannot say that tomorrow it will rain. It may rain. According to the weather, tomorrow it may rain. I will not be able to say that tomorrow it will definitely rain. It may rain. Are you getting the point? So that is called precision. This precision is known as what? Estimation uncertainty. Now, the next most important definition you have to understand is management bias. What do you mean by management bias? Yes, management is doing its work. Management is the one who are running the business for 365 days. So when the management is doing the work and running the business for 365 days, they know better about their entity. And remember, it is an estimation. It is not a precise figure where the auditor will treat it as a material misstatement. Even if the management biasness is involved somewhere, auditors shall not treat it as a material misstatement. Is it clear to all of you? Yes or no? So these are the four definitions we have to understand. The first definition, what do you mean by accounting estimate? The second definition, what do you mean by estimate uncertainty? What do you mean by auditor's range? And what do you understand by the term called what? Management bias. Now, next important thing what you have to understand is known as requirements of SA-540. Now, what are the standard 540 is looking for? 540 is looking for a very simple thing. They says that key yes, auditor shall do the RAP. What the auditor shall do? RAP. What do you mean by RAP? Risk assessment procedures and evaluate the related activities. How? Auditor will simply go to the management and ask them, please let me understand and evaluate the management estimates made by you. Who is saying this? Auditor is saying this to the management. So what the auditor will do? While performing the RAP, auditor first shall obtain the understanding of. Remember one thing, till the time you do not obtain the understanding of the client's applicable financial reporting framework, till the time you do not have the knowledge of client's applicable financial reporting framework, till that time you can never understand how they have made their accounting estimate. If you really want to know that whether their accounting estimates are certain or not, whether their accounting estimates are good or not, adequate or not, first of all, the auditor has to obtain the adequate knowledge of their what? Applicable financial reporting framework. Did you understand the point? The requirement of applicable financial reporting framework knowledge you have to acquire. Once you will acquire the knowledge of their required AFRF, then in that case you have to identify and evaluate management's method and identifying the conditions and events where accounting estimates are required. Now, once you acquired the AFRF, you should go to the management and simply ask them, sir, what are the areas where you have used your accounting estimates? Please let me know those areas so that I can go and do the needful checking. Did you get the point? Next point. Check how management has made those accounting estimates. You have to go to the management and you have to ask them, sir, what is your methodology of making the accounting estimate? Right? What are the assumptions you have taken? What is your source of information? What are the related controls you have used while making the accounting estimations? Right or not? What are the bases of your assumptions? All these questions the auditor has to ask whom? Management. Now see, check how management makes the accounting estimates, methodologies. You have to check their relevant controls. And you also have to ask, did they use any expert's advice or not? Are you getting the point? And most importantly, what are the assumptions they have taken and why they have taken those assumptions? So once you will acquire the AFRF knowledge, once you will understand and identify their methods or their ideas of making the accounting estimates, once you will evaluate the methodologies, finally check whether there has been any change in accounting estimate as compared to what? Prior period. So current year ka accounting estimate, you have to meet and match it with the prior period, and you have to see that are there any significant changes between the prior period and current period. Is it clear, everyone? This is what do you mean by RAP, risk assessment procedure. Now what is the next thing? Examine how management has assessed the effect of estimation uncertainty. Management also knows that, try to understand. Management also knows that when they are making the accounting estimates, definitely there will be a little bit scope of estimation uncertainty. They cannot be precise. Okay, what do you understand by the term called estimation? Estimation means approximation. Approximation means something which you do without any precise method of its measurement. That is called estimation. So you have to understand one fact that management is also not denying the fact that sir, little bit upside, little bit downside, it may happen. But yes, this is whatever approximate figure of provision. So you have to check that whether management has also assessed the estimation uncertainty or not. Next thing what you have to understand, review the outcome of the prior period estimates for the purpose of checking its impact on current period. Now listen to this very carefully. You just have to go to the management and ask them, sir, last year what management estimate you have made on this particular thing. Take the information on the prior period estimates and see its impact on the current year financial statement. If you think that last year ka accounting estimate does not affect the current year ka financial statement, then leave as it is. But if you think that ki last year ka accounting estimate does affect your current year ka financial statement, then it's better that you should assess the impact of that particular thing in the current financial statements as well. Is it clear, everyone? Next thing, auditor's response to the assessed ROMM. Now, after understanding the AFRF knowledge, after understanding the management's method of identification, after testing the management's methodology, and after checking whether there is a significant change of accounting estimate as compared to prior period or not, it's the time for an auditor. It's the time for an auditor to understand the fact that he will go and now he will do his response to the assessed ROMM. Let's say, for example, as an auditor, you got a little bit of doubt on the reliability of accounting estimates, what they are making. You got a little bit of doubt. Am I correct? Now, little bit of doubt means was, sir, I think there is a certain ROMM inside it. Risk of material misstatement. So, whenever you see ROMM, what does SA-330 tells you? SA-330 says that the moment auditor checks that there is a ROMM, he has to start responding it to bring that ROMM to the lowest acceptable level. Am I correct? Now, in this case also, what the auditor will do? Auditor will do 4 steps. Step number 1, he should check the subsequent events. What do you mean by subsequent event? He has to see that, check whether any event occurred up to the date of signing of audit report provides any evidence on what? Accounting estimates. Now, you all know that SA-540 deals with subsequent events. What do you mean by subsequent events? Those events which took place after the balance sheet date. Just simply go and ask the management and test that whether there is any subsequent event has taken place which is affecting the management estimate, due to which the ROMM level has increased. Point number 1. Point number 2, test management estimate. Sir, how do we do the testing of management estimate? Like how you evaluate it? First you evaluate it, now you do test it. So what are the tests we need to do? Check their methodology, check their relevant controls, check their assumptions they have taken, check whether they have taken the help of any expert or not. If they have taken the help of any expert, review the expert's expertise, review the expert's competence. All this thing is nothing but called testing of their management estimate. Sir, we understood. We have to take care of the subsequent event and we have to understand their what? Management estimate. So what is the next thing? Next thing is test operational effectiveness of the controls. Remember one thing, while making the management estimates, internal control system plays a very, very important role. An internal control system is that system where the auditor majorly spends his time upon. So whenever you are checking the management estimate, then in that case, it is your responsibility that test the operational effectiveness. Test what? Operational effectiveness of the internal control system. Check what? Operational effectiveness of the internal control system. Is it clear, everyone? Yes. So we first did what? We checked the subsequent event, then we tested the management estimate, then we also checked that operational effectiveness of internal control system is there or not, and last but not the least, develop the auditor's range of estimate. Just now before the starting of the standard, I told you these are the technical words, you have to keep it in mind. Auditor's range. What do you mean by auditor's range? Auditor will recompute the same estimate. He will compare his estimate with the management estimate. He will try to find the deviation between the two. If that rate of deviation between the management estimate and auditor's estimate is within his range, that is called auditor's range. But if you think that it has come within the range, the rate of deviation has come within the range, reduce your range. What you need to do? Reduce your range, contract your range. It means it's time that you should reduce your rate of deviation. Did you get the point? Now see what they are saying. When auditor uses his own assumption different from whom? Management. Right or not? Auditor shall evaluate any significant differences from the management assumption. So management might have used their own assumptions in making the accounting estimate. Auditor might have used his own assumptions while making the accounting estimate. So auditor's assumptions and management assumptions are different. Next, when the results are within the rate of deviation, when I compared the management estimation with my accounting estimation and the results are coming within the deviation, auditor shall reduce or narrow the range based on what? Audit evidence. I have to reduce the range of audit. I have to reduce the range based upon the audit evidence. So what are the 4 things we did? 4 things. First, we understood any subsequent event is there or not. Second thing, we did the testing of the management estimate. Third thing, I tested the operational effectiveness of internal control system. And the fourth thing, I developed my auditor's range. I took different assumptions. Management has taken different assumptions. I will compare their assumptions with my assumptions. If the rate of deviation is there, I will compare it. And if the rate of deviation is within, then in that case, I have to reduce my range accordingly. What? According to the basis of the evidence. Clear, everyone? Yes. Now, in case there is a significant difference, in case there is a huge difference between the management estimate and auditor's estimate, now what to do? In case there is a huge difference between the management estimate and auditor's estimate, what to do? Auditor shall respond by using some substantive procedures. Now remember one thing, TOC you have already done, testing of controls you have already done. You checked the operational effectiveness of the controls. You know that ki TOC and substantive procedure both comes under FAP, further audit procedures. And when the TOC may operating effectiveness of the control comes less, what is your responsibility? Your responsibility is to shift your focus more on substantive procedure and less on TOC. That is what they are saying. If the difference is significant, auditor shall respond by using more substantive procedure. How? What the auditor shall do? Auditor shall evaluate the following. What are the 3 steps he has to do? How the management has considered alternative assumption, why it has rejected the other assumptions while making the accounting estimate. Simply go and ask the management, ki why you are not taking the same assumptions which I am taking? Why you are not taking the same assumptions which I am taking? And if you are taking the different assumption, why you are rejecting this assumption? Simple si baat hai, sir. My accounting estimate and management accounting estimate is coming differently. So simply go and ask na ki why you have taken this assumption, and simply ask them, if you have taken this assumption, it is fine. But why do you think that ki you should not take my assumption? Why are you rejecting it? Evaluate. Second thing, what you should do, check whether the assumption by the management is reasonable or not. Now, ठीक है, first thing में I compared their assumption with my assumption. I asked them the reason कि why did they reject it. Now check the reasonability of management's assumption. Check the reasonability of management assumption. And once you will check the reasonability of management assumption, you will automatically get an idea कि whether the assumption taken by the management is right or wrong. And remember, third thing, try to understand whether the management is doing it intentionally or unintentionally. Whether there is any malified intention behind it or there is a bona fide intention behind it. What do you mean by malified intention? Wrong intention. What do you mean by bona fide intention? Good intention. If the bona fide intention, no problem. But if there is a malified intention, then there is a problem. Check management's intention to carry out specific course of action and their ability to do so. Did you all understand? Yes or no? Yes. Next point, but if the auditor is not satisfied, what is the next point? If the auditor is not satisfied, if the auditor is not satisfied by the reasons they are going to give me for rejection of my assumptions, if the auditor is not satisfied with the reasonability of the management's assumption, if the auditor is not satisfied with the management intention, then what the auditor should do? He shall develop a range to check its what? Reasonableness. Recognition and management criteria. Remember one thing, management estimates are the estimates which will be made by the management on the basis of some approximations by following some assumptions without any presence of precise means of measurement. So it's better that ki auditor bhaiya should go to the management and should tell to the management, sir, I am okay with your management estimates, just give me the WRL. Okay, I'm understood ki on what basis you are doing the management estimates, but do one thing, give me one MRL, give me one management representation letter. Give me what? Management representation letter. So management decision to recognize those management estimates which give rise to the significant risk, auditor shall obtain the SAE on the WRL. Take the WRL stating that ki management decision to recognize a not accounting estimate in the financial statement. It means management is completely responsible for taking the decision of including or not including the accounting estimate in their financial statement. That is a management's call. Next thing, the selected measurement basis for accounting estimates are in accordance with what? AFRF. So take the second disclosure also. Okay, whatever you are giving me, your accounting estimates are made by you as per AFRF. Is it clear, everyone? As per what? AFRF, right? Next one. Auditor must review the judgments and decisions made by the management in the making of what? Accounting estimate. Identify if there are any indications of management bias. In the beginning only, while telling you the standard, what I told you, that ki management bias may be involved, but try to understand this point very clearly. Management bias means management is becoming partial towards making the accounting estimate, and I think to an extent they have a right also. It's a very simple thing. Try to understand. Auditor does not spend that much time at the client space. He just simply goes to the client for a limited period of time. Who has the better knowledge about the entity and its operations? Management. If the little bit of management biasness is involved while making the accounting estimates, make sure that auditor shall not treat it as a material misstatement. If the auditor will treat it as a material misstatement, then it is a wrong on auditor's part, not on the management's part. So that concludes our standard SA-540 relating to accounting estimates made by the management, its checking, its fairness, and its disclosure. Now look at the name of the standard. What is the name of the standard, everyone? Auditing the accounting estimates and examining its fairness and disclosures. Auditing the accounting estimates and what? And examining its fairness and disclosure. So that brings an end to your SA 540, everyone. Is it clear to all of you? Yes, sir.